All right, let's for the last few minutes talk about regulation, which is something we've touched upon. Obviously, it's dear to everybody's hearts at the moment. And Patrick, you were saying that regulators are really behind the curve in terms of what's actually happening in the market, and you hinted that it would sort of inhibit some of the things you were able to do.
Yeah, back in the 90s, back in the day, when sort of the birth of internet advertising was coming along, which we did quite a lot of pioneering on, the conversations we were having in sort of legal and compliance were how on a sort of little banner strip ad on top of an ISP that you'd actually need to regard that as pages turning on a direct mail pack as opposed to a piece of print ad. Otherwise, the amount of small print we were going to have to try and force onto a little banner or a button on a website was going to make it impossible. And the regulator at the time, it took some time to get them up to speed with actually this is what's happening, and we spent a lot of time working with the regulators and advertising standards and all the rest of it to sort of start to establish a new set of rules. And just as those sorts of are sort of becoming sort of bedded down and look very old-fashioned now, along comes social media and other things where customers are expecting us to be. It's not, are you there? Is something happening? It's they're going to expect you to be there and expect you to interact. And actually, we've got to get the regulations up to speed so that we're going to be able to do that, because it could be a lot more important than just customer satisfaction. There comes a point where activist customers are becoming a bigger and bigger part of life.
Mark, on the regulatory side, there's obviously a question of banks conforming to the regulations, but there's different ways of doing it, isn't there? So you can actually sometimes conform to new regulations and get some actual value added by changing your processes and bringing in, sort of stopping a sort of silo approach to banking and kind of bringing your data together. Would that be the ideal for what you would recommend to banks?
The ideal for what we might recommend, because that would bring us business. I think that's true.
You weren't supposed to give the game away.
Yeah. Certainly modern technology solutions make regulation much easier to comply to without any question at all, simply because you have a full view of the organisation, the products are adaptable and changeable and things like that. I think our experience of regulation, and of course we're intimately involved in it as a supplier, has been that, and we would agree totally, the next set of regulation is going to be profound, because our experience to date has been that in general the regulation seems to be around regulating what the bank wants to do today and just changing a little bit. So we're just steering the systems or the solutions to provide a bit, some more information, some more processes. The next set of regulation we think is, would seem to be much more profound and changing the whole business model of banks dramatically. Maybe it's even less impact on systems and solutions, more on the actual business model of the bank, and we see that as being a very dramatic change, very dramatic.
Patrick, you mentioned you were worried about specific products like credit cards and mortgages. Can you tell us why?
The law of unintended consequences, as consumer protection regulation in particular gets put in place, you could argue that if the amount of capital banks were required to hold against mortgages was sufficiently high, the rates that they would have to charge to get the return on those mortgages, could be very unattractive and could actually alter the housing market in terms of house prices over the medium term.
Yeah.
If you put caps on certain lending products, APR caps, that could then mean that for chunks of the UK population that just would no longer be sufficiently rewarding based on sort of the risk-reward ratio to actually offer products to those people. So you could take products that were actually away from chunks of the UK consumer. And so we've got to be very careful with the regulation that it actually has the effects that we're actually looking for in terms of protecting the consumer, but having a very inclusive agenda for as many sort of consumers as possible.
Well, tell us a little bit, Toby, about your approach to risk management at Nordea. I mean, it's always a difficult one, isn't it? Because when the market's booming, people become a bit risk averse. There's a huge demand for products, and the inclination is for the risk manager to kind of just sort of backpedal a bit, and then suddenly we go shoot to the other direction and become, you know, very risk conscious, almost go to the other direction. I mean, how do we manage to get a risk culture that's
Building on what Andy mentioned, the starting point for the risk management culture in our context is our value, our set of values, great customer experience as one example, and we start from there, and we have the culture that has sort of prudency in risk management built into it. And if we reflect back, for example, a couple of years and look at Nordea, we came through the financial crisis in a very strong position simply because of the fact that we only focused on customer business and knowing our customers. So we did not have any exposure with, you know, subprimes and the likes.
Yeah.
And I think that is the key. And therefore, I would be very, very much in the same on the same page with you, that it all starts from the culture, from the values of the company, and the proper risk management processes from the formal perspective are basically a consequence.
Mark, I mean, do you feel that banks are, you know, the financial crisis has given banks an opportunity to really review everything about their risk management and in some ways to make it a more human process, really, because one of the critiques of their models was, you know, they ticked the boxes, but didn't actually show up the risks.
I think the best banks never did that. I think the best banks always ran risk as had a culture that understood risk right through the boom times and not. And that's our experience with our clients, without any question. Whereas the other banks that perhaps did change their approach and change their attitude depending upon whether the markets were good or bad, they have a very good opportunity to tighten that up now. The important thing will be, I would imagine, for them when the boom times come back, they should keep that risk understanding in place. And it's very clear in the clients that we have, the ones that moved smoothly through the financial crisis, of which there are many, and the ones that really suffered greatly.
Okay, gentlemen, we are way over our time now. It's been a fascinating discussion, and we certainly covered a lot of ground there. And I think that what I said at the start has proven to be the case. I mean, we are in a very exciting time in banking with a lot of sort of new opportunities being thrown up, either not related to the financial crisis or because of the financial crisis. But thanks very much indeed. Thank you.
Thank you.
Thank you.